Ladies and gentlemen, we're here today to talk about using data analytics for capital allocation strategies. I'm Lolla Stovall, Counsel at Zuber Lawler, and I handle corporate transactions and M&A work, including cannabis-related transactions. If you notice my accent, this is a clever ruse by our marketing department to make sure everyone stays awake and pays attention. We appreciate each of you for taking the time to attend, and of course our panelists for joining us. Many of you are familiar with Zuber Lawler due to its well-established credentials in the cannabis practice. About 15 years ago, Zuber Lawler took pride in learning everything there was to know about cannabis and sharing it before it became mainstream. What you may not know is that the firm is also nurturing and growing many other innovative practices in emerging industries such as cryptocurrency, e-gaming, non-fungible tokens, psychedelics, and many more niches, including fintech. In addition to cultivating legal expertise, we also pride ourselves on being connectors in the industry and bringing together clients and contacts across various sectors. So here with us today are Morris Denton from Texas Regional, Scott Greiper from Viridian Capital Advisors, and the founding partner of Zuber Lawler, Josh Lawler. Scott is the president and founding partner of Viridian Capital Advisors, and he has had a 20-year distinguished career in technology, security, IT, and both on the research side and on the investment side. Over time, Scott has been involved in raising more than $500 million for both public and private companies, and completed a range of M&A deals. Mr. Greiper is also the president and founder of Secure Strategy Group, which provides capital, strategic advisory, and M&A services to growing companies in the technology, security, and IT spaces. Prior to that, Mr. Greiper was one of the top analysts covering public companies in the global security industry. Morris is the chief executive officer of Texas Regional. He's a native Texan, and he brings a unique perspective to the medical cannabis industry and works very closely with Texas legislators and the Department of Public Safety to create and build a truly legal medical cannabis industry that we can all be proud of. Morris is an accomplished executive with 3 decades of leadership experience in technology, consumer packaged goods, sports and entertainment, products and brand marketing, and a variety of other industries. He specializes in crafting leadership positions for brands and for businesses that enter highly competitive markets. Morris lives and works in Texas, and his business is present in Austin and recently also in Houston. Now on to Josh Lawler. Josh doesn't know this, but he is the main reason I am with Zuber Lawler. I'm convinced that there is not another lawyer out there who is this precise with his words. Josh handles M&A, finance, and corporate matters for private equity groups and public and private companies, both domestically and internationally. He's also represented leading cannabis companies for 14 years and has extensive experience with complex deals in the cannabis space. He counsels cannabis companies on acquisitions, mergers, post-acquisition, and post-merger integration. And he works with a lot of leading cannabis and blockchain companies, positioning them uniquely well to be at the intersection of plant and blockchain technologies. So Morris, what can you tell us about capital allocation? Why is it important for a CEO of a company?
Well, I mean, look, running a business is extremely challenging and complex. And I think one of the things that I like to try to do is to simplify things. When I think about capital allocation, it's basically, where do you want to deploy capital and when for the maximum impact and return on the business, right? And for us in Texas, in a vertically integrated medical market, not a full medical market, we're working towards that end, but in a vertically integrated medical cannabis market, there's really kind of 3 big places that become drivers for the business, strategic drivers for the business. One is the production engine, right? So it's everything that we need from cultivation to finished product. So that's cultivation, that's manufacturing, that's refining, that's testing, that's packaging, et cetera. Within that production engine, there's a lot of capital requirements. The second is in our go-to-market game plan, a retail strategy, a distribution, fulfillment, deliveries, et cetera. There are ways to create differentiated strategies through investments into infrastructure or into technologies, right, that can create differentiation for us in the market. And then the third place is, you need world-class talent, super smart, good people in order to run those assets well. And so for us in Texas, when I think about capital allocation, it's really just trying to simplify where you put the money to generate the maximum return.
So what is then data analytics, and why does that matter to capital allocation?
Well, I mean, you gotta, in order to know where to put the money, you got to be pretty smart about how your business is performing, number one, right? And you can't do that flying blind, so to speak. You have to have good inputs. And in order to have good inputs, you need to know what you're measuring and the type of data that you're looking for. And certainly when it comes time for you to go raise money, you need to know not only what your business is doing and how your business is performing, but you need to know what the market is doing and how the market is performing so that you can have an understanding of what your value is when you go out to try to raise money.
So what type of data is available from Viridian Cannabis Deal Tracker? What is it?
So it's the type of data that an investor, a company, a board would find in a Bloomberg terminal or in a pitch book license. We just happen to focus on one industry, which is the cannabis and at large hemp and CBD industry. And so it's data on investors, which investors have invested in the space, what type of company, what type of investment, is it equity or debt? What scale of the business? Is it seed? Is it ABC round? Is it growth capital? Is it acquisition capital? What was the structure in terms of that investment? Is it preferred versus common? Are there warrants? Same thing on the M&A side. Who are the buyers? What have they bought? How do they price? How do they value? How do they structure consideration, cash, stock, earnout? It's a database that we started building in January of 2015. So we're 7.5 years into compiling what we believe, and Benzinga recently quoted as the world's largest database of cannabis and CBD deals. And it's not just tracking a deal, it's tracking specifically how did that buy-side player, acquirer, seller, investor, lender, value the company that they just came in at? Is it a multiple of revenues? Is it trailing or forward? Is it a multiple EBITDA? Is it cash flow? Is it assets? Because when we take on a client like Morris at Texas Original, you don't go into the market blind. Well, you can, but you're going to get back the results of that effort, which is going to be poor. But if you go into it understanding how Texas Original is positioned itself as a leader in Texas, how they price their products, how they get their products to their consumers, how they grow, how they develop lower cost of production. All of this goes into understanding how we can raise them capital, what the likely terms and structure and valuation is, and in a very targeted sense, in our network, what investors we're going to speak to. So it just gives the ability of a CEO like Morris to have an understanding before we ever go out into the market, what we should expect in terms of structure, terms, and valuation. And that's the most educated way to go into a transaction because it gives you the most leverage because you have the knowledge, you have the data on your side.
So what is happening now in the market and how do you go in the market now? Would you like to talk a little bit about that?
Well, I think I blew all of that talking to you guys a bit about that before we went live, but I'll recite it again. Just kidding. We're in a very, very challenged environment, particularly for equity capital. The most challenged environment I think the industry has ever experienced. Pretty sure about that. That's a problem because cannabis, at least according to Bloomberg, is the fastest growing industry in the world today. And certainly in the US, where we recognized about $26 billion of legal cannabis sales last year, growing at about a 30% CAGR. It's pretty massive for a global industry. It's hyper growth. Expansion capital is constantly required. And yet the availability of capital is at the lowest level we've ever seen. So what the hell do you do if you're an operator like Morris or you're an investment bank M&A firm like Viridian Capital? Well, you do what I learned 30 years ago on Wall Street, which is proverbially, you don't fight the tape. All of you have heard that jargon. You don't fight the tape. What does that mean today? Equity capital is nearly impossible. And if you're going to issue equity capital, it's going to be expensive. It's going to be a high cost of capital. It's going to be incredibly dilutive. So what do? You look for other sources of capital. Principally, that's been debt. It's been debt financing that has taken up the gap or the lack of equity capital in the last year and a half. In fact, in the first quarter of this year, according to the Viridian Cannabis Deal Tracker, debt represented 61% of all injections of capital in the industry globally. 2 years ago, it was about 10%. So thank God for the emergence of the lender in the industry. So you have to be creative in finding other sources of capital, whether it's debt financing or what Texas Original and Morris just completed, which is a sale leaseback of transaction of their real estate, converting real estate from a asset on the balance sheet to cash.
Yeah.
So that's what cannabis companies are doing today.
Scott, are you seeing heavy warrant participation? Because the one thing that's kind of a little oxymoronic in what you just said is high growth industry and debt deals. It's obviously the upside that makes the whole industry attractive in the first place.
Yep. It's a really interesting question, Josh. We recently signed on a cannabis company. And they basically effectively told that we're raising them debt. It goes along the lines of what we just say. We wouldn't have taken it on to raise equity anyway. So they agreed to let us take on debt. And they said, whatever warrant coverage your lenders need or want on top of the debt, which hopefully has a reasonable cost of capital, a reasonable coupon, you tell us what kind of warrant coverage you want and what pricing on the warrants, and we're going to eat it. Because to get a reasonably priced piece of debt, the company is willing to give up as much, warrant coverage as the lender might request. So, it's interesting, Josh, because the emergence of debt in this industry, which really only happened the last 2.5 years, you saw traditional debt, senior secured, asset backed, 3 to 5 year term, whatever the coupon was, whatever the prepayment penalties were. Now, because debt is really all that's available from capital, the lenders are mandating the equity kicker, the equity upside, and they're getting it.
What about Scott? I mean, look, debt is obviously probably the most available source of capital at this point in time, but from an operational or from an operator's perspective, the things that we're nervous about, not just is it the price or the cost of the overall capital, but what we, before we went out and did the sale leaseback transaction, we looked at a variety of different options, which debt was one of those options that we looked at. But, there was a lot of covenants that were there that, I understand why the lender would like to have those, but holy cow, man, some of those are tricky and sticky. And they can create real significant issues for operators if we're not careful.
They can, and they.
I mean, are you seeing these covenants getting more widespread in the deals, and are they getting are they coming with sharpened teeth, so to speak?
I'll start with this, Morris, because it really tells the tale of where we are in the industry right now. The largest capital raises last year were all in the form of debt for 2021. And the largest capital raises year to date this year have been for the lenders not cannabis companies. The
Mhm.
lenders themselves cannot get enough capital in from limited partners because they're making such a huge spread on what they're taking in money at versus lending money out. There's such a huge spread. They can't raise enough money. It's weird. It's a very weird dynamic. But so they're in the lenders in the catbird seat. They can dictate terms. They're being, look, they can. It's a buyer's market today. Whether you're an acquirer or a lender, it is a buyer's market today. So, and you probably went through this, Morris. Whatever the coupon is, it obviously is based on size, right? The biggest public MSOs are getting loans at between 7 to 9%. Maybe there's a point of origination fee. Maybe there's 18 months of a prepayment penalty, but it's pretty vanilla. You go down tier from those top 15 or 20 public MSOs, and it's a completely different ballgame, okay? The cost of capital is probably going to be in the high teens. There's going to be 3% origination fee. There's going to be a 2% diligence fee. There's going to be a breakup fee. And whatever appraisal you have on your property, that is a real warehouse, a real cultivation facility, they're going to discount it because they're not going to give you a cannabis value to the lands. They're going to give you a non-cannabis appraisal. The lenders say, and it's true, because what happens if the state comes in and shuts you down, and now we're stuck at this warehouse, you can't grow this very profitable crop anymore. I'm not giving you a cannabis appraisal. So the loan to value ratio is not based on what you're actually worth. It's discounted typically by 20 or 30%. So in answer to your question, Morris, of what you're experiencing, I kind of think anybody would do it in the same position if they were the big lender. They can, and they're getting whatever they're asking for because it's one of the only sources of capital today.
Yeah, and how sticky is that prepayment penalty? Because I mean, I can tell you from the legal perspective, if I'm negotiating the deal, I would sit there and be like, okay, all the other bells, lights, and whistles, with the possible exception of massive warrant coverage, all go away if you prepay the thing.
Yeah.
So that's the kind of linchpin for a temporary environment, hopefully temporary.
Yeah. I guess I look at it similarly, but maybe a little bit of a different perspective. So you have the IIPRs, you have the AFCs, you have the New Lakes, that have become relatively large, that have been raising a lot of capital because they're making such a huge spread on borrowing versus lending. And they're going public. And they're going public because they now have a portfolio of 15, 20, 30, 40 cannabis companies that they have loans out to. Those companies are paying their coupon on a current basis. So some of these companies are recognizing 17, 18% monthly IRRs in their portfolios. Wall Street loves that. Wall Street salivates for that. They always have. So these companies are now going public. So they're going public because they're getting a visible, predictable stream of interest, right? If those companies, if those clients that they've lent money out to are prepaying the loan, it may be a cash windfall, but it hurts their IRR. That's why those prepayment penalties are so harsh. And they should be from the lender's perspective.
From the lender's perspective.
So Josh, you see a huge deal flow, right? A lot of variety. So what are those covenants now that have emerged that you haven't seen before?
Well, all right. So there's nothing I haven't seen before. There's nothing new under the sun, as it were. And I've been doing this in one variety or other for 28 years. So it's that's not been the issue. I mean, the things that we see that are the normal things are, the warrant coverage, and equity kick is, usually where I kind of see kind of the most extreme kind of, call it transaction expansion, being generous. And, usually on this, I would be on the borrower's side, not always, but frequently. So, you look at the warrant coverage and it's kind of like all that in a bag of chips. They're surprisingly, I mean, and I don't know what you've seen, Scott and Morris, but, less in the financial ratio covenants That hasn't come into play quite the same way. And obviously, if it's a secured loan, there's reason for that, and pretty much everything is secured on the debt space. But I haven't seen kind of the same coverage and fixed charge ratios being really as high as they have been in some other industries that we've seen. I don't know what your experience has been, guys.
Yeah, Morris, you want to jump in there?
Well, I mean, we've seen a pretty wide spread of a pretty wide variety of requests on the covenant side that can range from, revenue growth to expense management, to cash flow, to EBITDA, to, basically anything that they can sort of put a bogey on and then measure, right, and track to put us on a cadence or a treadmill or what have you, so that they have higher confidence in our ability to continue to pay, whatever the mortgage is or the debt service or what have you, right? So, I think it just really depends on who the lender is and what they're looking to do. The good news is that the majority of the lenders that we talk to, they don't seem to be truly motivated sharks, so to speak, where they're trying to, trip you into basically a foot fault on a covenant that could then trigger some sort of material impact, right? And at least the ones that we've talked to, have expressed that that's the last thing that they want to do is to become an operator, but it's more about just trying to protect their investment. But I mean, we've, like you, Josh, we've seen a lot, right? And given the environment right now, it wouldn't surprise me if some of those covenants are getting, even more aggressive, because of, again, the environment and the leverage in whether it's a buyer's market versus a seller's market.
Yeah. I think maybe one aspect, and it's so funny, I use the term foot fault frequently, but the enforcing of the foreclosure process on assets and such is so much more difficult here because of the licensing and regulatory than it is in some other contexts that, nobody's going to go after that particular foot fault in most cases. We've had to put in some really kind of extremely creative structures in terms of, collateral managers and things of that nature to kind of stay within the regulatory bounds, particularly when, there's THC product as part of the collateral package, because most of the lenders just can't just grab that. It's not what they're able to do.
Right.
Yeah, we've also seen, because so much of the debt has gone to, the debt financing has gone to the larger pubcos, the larger MSOs, as you would suspect. They have big portfolios of owned real estate, unencumbered real estate in some cases. So easy to lend against, hard assets at whatever appraisal value it is. They have a diversity of operations. They're in 15 states, not one or two. Just more fundamentally strong companies, right? So those guys have kind of been taken up. So the lenders are now moving downstream to the second and third tier companies, public and private. And now you're dealing with higher levels of risk operationally, management-wise, scale of operations, risks of being in a single state. And so the covenants and the risk profile of these operators is getting more severe for the lender. And that's where the more, the tougher covenants come in, Josh, because the risk profile of those companies for the lenders is more significant. And so we're just seeing kind of harsher structures coming in. And in many cases, those are being accepted because what choice do those operators have?
All right.
So size matters, it always does, but it really does in this industry because, artificially we're state to state, county to county. And these single state operators are taking it on the chin.
And we have seen this in other industries, right? We have seen the series of defaults in the real estate, then in the energy sector, and now cannabis. And I would proffer that never did the bank want less of the actual ownership and operatorship of a defaulting borrower, right? Just because of all the strings that are attached, that Josh pointed out. But Question is, how does that translate into what we see in the data analytics, Scott? Is there some of those softer risks? Are they visible? If you compare information that you would see in a more conventional industry, would you see some additional categories of information that our audience should be on the lookout for?
Yeah, if I understand your question, Lola, I think what the data is showing, because the Viridian Cannabis Deal Tracker, in addition to tracking all the deals and structure, we track deals by location of the company, the issuer, right? The state that they're located in the States, or the country that they're located in outside of the United States. And we track deals by sector, one of 12 industry sectors, from cultivation to retail to ag tech to real estate, software, et cetera. What we're starting to see is it kind of goes back to size matters. Capital is flowing primarily to the larger limited license states. There is no large limited license state like Texas in the cannabis industry today. There's not a close second, right? Morris, I mean, got the very lucky break of Morris contacting me a few years ago, and we helped him not only on the data side in understanding how we could raise capital and the likely term structure, but we were able to close a couple of deals with him. But Texas, second largest state, there's 3 operators. There's no metric like that in this industry. Still, in my opinion, the most valuable state in terms of the potential. California is obviously the largest in actuality, but in terms, so back to your question, you know, California, despite the very severe draconian declines in pricing that came in about a year ago, the MSOs, the public companies that positioned themselves in the California market, have outperformed over the last 6 months, even against the larger Curaleafs, Truliefs of the world, because California is starting to get its act together. So we're starting to see a flow of capital based on region and based on sector. So California, New York, New Jersey, are attracting more capital than they did a year and a half ago. Size matters in terms of population. Population dictates scale and consumer base in this industry. It just does. So we're starting to see a flow of capital to those larger states, both debt and equity. And in terms of industry sector, cultivation and retail, which is basically the supply chain, it's infrastructure, it's the grow, indoor, outdoor greenhouse, it's manufacturing, processing, and it's retail. You got to stand those 3 up to have a business. Used to dominate probably 80, 85 cents of every dollar, going back to 15, 16, 17, 2018, went to cultivation and retail. New states went medical, operators need to stand up infrastructure. States went medical to rec, operators need to scale infrastructure. This year, we've seen the lowest level of capital going into cultivation and retail, and more capital going into software, because we're in a more competitive pricing environment. In more and more states, it's not just California that is sort of seeing the beginnings of commoditization of flower. It's Colorado, it's Massachusetts, it's Michigan, it's Ohio. It's not only the legacy states, it's the new states. So what do you do as an operator when you're in a more competitive pricing environment? Efficiency, lower cost of production, more advanced technology. That allows you to bring down your production cost and run a more efficient business. What does that mean? Ag tech, lighting, HVAC, nutrients, command and control systems. We've seen a lot more capital coming into ag tech, software. You know, we're not in the days of QuickBooks anymore. So advanced ERP systems, so you can better monitor, track, execute, account for, control your business. Much more capital and M&A coming into the software sector. So ag tech, software, and biotech. It's a little off the beaten path here, but in answer to your question, Lola, the level of risk tolerance, which is at historically low levels in the world, forget about cannabis, our world is kind of on fire. And so there's a lower level of risk tolerance. And so there's a push for safety and liquidity. What is safety and liquidity? It always happens when you go through cycles, right? Safety and liquidity in this industry doesn't mean the T-bill. You know what I mean? Going to put your money in a safe place with the government. It means looking for size, diversity, and scale. That's why the larger public companies continue to capture the lion's share of the capital. That's why the larger states, California, New York, New Jersey, are capturing bigger portions of capital. It's a risk mitigation effort on the part of the capital providers.
So Morris, what do you do in this environment? You talked about allocating to operations, marketing, talent, right? But you have virtually no comparable competitors in Texas. You have two other companies. They're not really the same, correct? Do you go out of state to look at the data? Or do you still focus on your local competitors? What is more important?
Well, I mean, I think we could get easily distracted by focusing a little bit too much on would-be competitors or on our existing competitors. It doesn't change what we need to do in terms of how we deploy capital, right? Scott just kind of walked everybody through the different requirements, and those requirements are very acute for us in Texas, right? I mean, we've got to have a production engine, is what I called it, which consists of a significant cultivation component, a significant manufacturing component, and then the marketing that you speak of is what I call go-to-market activities, which includes retail, which is very heavy capital intense, right? It's distribution, it's delivery, it's fulfillment, et cetera. For us in Texas, in being one of the three licenses, we look at the money that we're putting into our business as actually creating the industry in the state of Texas, right? There's a massive market that's here in Texas. What we need to do is we need to invest into the infrastructure that allows us to capture that market and turn it from an illegal market, from an illicit transaction into a legal transaction, right? And so the requirements on us are pretty significant. So we're still looking at, what are the best ways for us to deploy that capital? Where do we need to deploy it? And in order to do that, I mean, look, we're, good or bad, right or wrong, we can look to other states and see what operators have done in other states as a proxy for what we may want to do in Texas, right? And so we do a lot of analysis and studying of the investments in the capital allocation strategies that other leaders in other markets have done ahead of us, right? And we'll even call up those operators and try to pick their brains a little bit because, we feel like we've got a once in a lifetime opportunity, frankly, to not just lead a state, but to dominate a state, and to dominate a state the size of Texas with 30 million people in it, in a limited license, vertically integrated fashion, represents a significant opportunity for us. And so we need to be really smart about how we go about that.
Correct. And we actually have a question from one of the operators who is asking, do MSOs cut assets or sell off lines of business when they understand, based on the data analytics that's available, that they have overbuilt for the demand? Or do they hold, do they burn, what happens?
Yeah, I'll jump in here, Lola. So we're in a distressed environment, and in any distressed environment, whatever the industry, you start a phase of restructuring, right? Because companies have to do it to cut back to core assets and allocate capital to those revenue producing, cash flow producing assets. And it's happening here, happened in 2019. So we've seen, and I won't name names, but large, medium-sized MSOs starting to sell off. They're not burning. I'm looking at this question. Do they burn? I don't think they're burning anything. They're looking to get some cash out of it. But to start to sell off, I don't want to call it non-core assets, but assets that are not core to financial performance. And because these are public companies that are filing every quarter, that's all that matters to them. So they are going typically through sell-side M&A processes, sometimes engaging us or other banks, sometimes doing it on their own. So they are divesting assets that they don't believe are core to the current and future financial performance of the business. We're not seeing MSOs shut down, liquidate. They're mainly running M&A processes. We are seeing shutdowns and liquidations in a state like California, right? Where you just have non-competitive, non-performing licenses that they're not getting funded, they're not getting acquired, they're not doing an RTO in Canada. They really have no alternative. They're shutting down. But the MSOs are going through a divestiture process for assets that they do not consider core.
So you don't see a huge trend of hold and burn, basically. You see divestiture and reduction and optimization, correct?
When you say hold and burn, you're talking about burning cash to waiting for the cycle to turn?
Waiting out, exactly, waiting out for the market to turn.
No, I don't see that at all. If cash was more readily available or coming with a lower cost of capital, sure, you would hold on. That's just not the dynamic in the market right now.
Yeah, I think that there are some MSOs that are making strategic prioritization of markets something that is really in focus for them, right? So in other words, not all markets are created equal. If you're an MSO, you may have licenses in 5 states and 10 states and whatever the number is. You know, there are some states that are going to be more important to your near-term viability or mid-term viability than other states. And so you're going to prioritize, again, from a capital allocation perspective or from a focus perspective, you're going to put more of your focus into the markets where, you know, you have an opportunity to have a meaningful impact on the broad collection of your businesses, right? In other words, you're not going to spread your attention and your money on a pro rata basis or on an even basis across the 5 different markets in which you have licenses. And some MSOs may even go to a further extent where they'll look at an underperforming market and look to shed that, right, by selling off that license or what have you. So, you know, I think that, you know, in today's market, I mean, you know, anything is fair game from that perspective.
That's true. Josh, what do you think from the legal perspective? Receivership, bankruptcies, or only M&A?
No, I mean, well, bankruptcies in cannabis are difficult to begin with just because of the federal law aspect to it. But no, I mean, you know, we're talking about carve-outs. And from a legal perspective, carve-outs are fun. From an accounting perspective, they're not. You know, I think that there's opportunity here, you know, where some of the carved out assets, you know, one man's trash is another man's treasure. And for, you know, some of the mid-tier and smaller operators to pick up, you know, some of the underperforming assets, if they can find a way to do it, recognizing that capital is costly, but, you know, there are certainly a lot of other structures that are, you know, less capital intensive up front. If somebody's looking to just kind of shed assets to particularly if it's a focus question, and they might be more willing to defer payment or have a heavy, you know, earn out component that doesn't really require the same level of, let's just call it, I guess, operational restriction that that new debt would require.
Good. And so there was some indication, Morris and Scott, that you worked together on a transaction. Did I understand that correctly? Would you like to talk a little bit about that and how things were flowing in real time from Scott to Morris and back from Morris of the data into the system?
I was waiting for you to ask me that question. Yeah, as I said before, you know, luck plays a big part in all of our lives. And I guess, I don't know, Morris, 2.5 years ago, you were in town here and you called me up and I think you asked me, are you Viridian Capital? And I said, I am. And he said, oh, I'm Morris Denton. I own one of the 3 medical cannabis licenses in Texas. And I think I jumped into my Batmobile and I was at the hotel where Morris was at in about 3.4 minutes. And yeah, we engaged. And I think the most valuable thing we did with Morris, because, you know, Morris has built up an organization of talent and structure But I think what we really helped him do was figuring out his financial modeling, his forecasting. Morris called it the MOAS, the mother of all spreadsheets. And it's part of what we do with every client. It's not just going out and getting the deal into the market. The financial forecasting is the most critical thing to me. You know, I get business plans and PP every day, and I just need to look at how a company models out its income statement, balance sheet, cash flow. And I could pretty much tell you very quickly the experience or lack thereof, the credibility or lack thereof. So we helped there, and then we ran a valuation analysis of what the company would be worth going out and raising capital, and what would the cost of capital be, and how much of the company would have to offer, and what type of buy-side people we would speak to. And we closed 2 successful capital raises together. So I hope, Morris, that the advantage we brought from the data from the Viridian Cannabis Deal Tracker helped close the optimal transactions for you.
Well, I think, look, I think that the MOAS was something that I created almost in the dark that you guys were able to poke at, but I can assure you that since then, and us bringing in an extraordinary CFO and a gentleman by the name of Stephen Yu, who, has had a lot of cannabis experience, our financial modeling and capabilities have only improved over time, because they've taken that away from me, which is a good thing for all of us. But where I think the biggest value is the outside in view, Scott, that you guys brought, right? Which is, the ability for you to, in a meaningful and data-driven way, to illustrate, here are the transactions that have happened. Here's why this is an interesting proxy for your business. Here are the things that are nuances that are special and unique about the Texas market and about your position in the Texas market. And here's what we think the range is of what you guys might have from a valuation perspective and what the general terms may be. And I can tell you that, having that kind of visibility into, what a potential expectation is invaluable once you step into the fray, right? Because once you step into the fray and you start to really understand, because, look, the market, beauty's in the eye of the beholder, and, valuations are driven by the investing entity as opposed to the selling entity, if you will, on our side, right? We can sit here and say, hey, look, we think because we're, the top performer in Texas, and Texas is the largest state, that, our value is way up here, but they may be coming in and saying, no, here's why we think it's over here. And so, for, look, the number one thing that I think you got to know before you go out is, what's your general sense of worth and value? Because if you go out and you think that you're, the worst thing that can happen is you get this really big spread between what your expectations are versus what the realities may be, because that just introduces all sorts of potential downside. So I think the biggest value add, Scott, that you guys brought was a credible and realistic view on what we may be able to accomplish, and then helping us work through, the different things as they started to roll in.
So Morris, I know that you're a very discerning user of data. You don't just take everything that Scott provides, but from our prior conversations, it's clear that you know how to discard and calibrate. Would you talk a little bit about that? What are the dangers of overusing data analytics? How do you calibrate? And
well, there's, I don't know how many different ways there are to value a company, right? I mean, you can, there's, almost endless way, right? There's endless ways you can look at doing comps or proxies or what have you. At the end of the day, I think it's important for the operator to again have a very solid understanding of their own business, and how their business operates and how their business competes and what makes them unique. And all those value propositions need to be delivered in a credible fashion to the investing entity, regardless of whether that's an MSO or a private equity company or an investment bank or a family office or what have you. Some of these folks might look at your market and your industry and have a whole bunch of opinions about what it is. But that doesn't necessarily mean that their opinions are right. And we have a lot of conversations about the Texas market, where people come in and they think they have an understanding of what the Texas market actually is, but they're way off, right? And so we have to spend a lot of time educating people about not just who we are, but how this market operates and ticks, and what the future might look like. So, not all data is created equal. And you got to be, diligent about trying to understand what the data represents and the story that it's telling.
So indulge us a little bit. Talk to us about Texas market, and especially your place in it, Texas Regional's place in it.
Well, there's a few things that just, a lot of people think it's a hemp market, which it's not. Okay, this is a THC market. There's a limitation on the amount of THC that we can have in our finished product, which is at 1% by weight. And so people think on the outside, oh, well, that's really low THC. And yet we make, products that contain 20 milligrams of THC in each serving, right? Which is a significant, dose of THC. Anybody that's gone to any of the recreational markets, they know that the standard dose is either 5 or 10 milligrams of THC, and off you go. And so we make, because it's 1% by weight, that means that, if you have a 2 milligram, or if you have a 2 gram gummy, okay, that means you can have 20 milligrams of THC in it and still be at the 1% by weight threshold, right? So, we manufacture those products. Right now, the qualifying conditions in Texas, there's a couple hundred of them, and they range from all forms of cancer to PTSD to this big bucket called incurable neurodegenerative conditions, which consists of, a couple hundred different sort of smaller conditions. There's still the 3 big symptoms that are prevalent in Texas that we spend the majority of our time treating are the same 3 symptoms in all markets, which is pain, anxiety, and insomnia, right? And those 3 symptoms are prevalent in the vast majority of the conditions. And so, in Texas, you can be seen by a doctor virtually. That doctor can diagnose your condition. They can enroll you in the program, and you can see us and then get on our distribution and delivery or pick up the same day, right? So things are moving along pretty efficiently right now. The biggest challenge that we face as an industry is, we'd love for chronic pain to be a qualifying condition in and of itself. It's fascinating to me that chronic pain as a condition arguably has the most efficacy, the most proven scientific data that supports the impact of THC and cannabis on alleviating the symptoms associated with chronic pain. And yet it's not a qualifying condition in Texas. And then we want to be able to store inventory. I mean, believe it or not, it's 1,000 miles from end to end and north to south in Texas, and yet we can only store inventory in our one location, which makes it, beyond onerous and punitive to the patients because it limits their accessibility, right? I mean, every time, here's another quick thing too, is, Texas is a border state. We've got 600 miles roughly of border with Mexico. And everybody hears about all the border issues and the illegal immigrants and all the fentanyl that's coming across the border and everything else. And there are all these border checkpoints that are set up as you come back in. Well, based on state regulations, if we're delivering down to a border town, which includes El Paso, all the way down to Brownsville, McAllen, and points in between, when we come back from making a delivery, we got to go through a border checkpoint, and our drivers get stopped and they get asked, what do you guys have? And it's not uncommon for them to be detained, all because of the state regulations, coming back through a federal checkpoint. So there's a lot of things that, need to be improved in the Texas market, but there are also a lot of things that are going really well here. And again, sort of like how we're looking at other players that are ahead of us, the state of Texas is also eyes wide open and ears open when it comes to looking at what's happening in our neighboring states, but also in other markets like Colorado and California and Washington and Oregon, where you see, a little bit of what happens when you have very little regulations or if you have too many regulations, right? And so I think Texas is trying to thread the needle around having the right kind of regulations in order to create a market that can be viable, not just for the operators, but something that's patient driven as well.
So very interesting. Basically, you solved the visually low THC regs by creating Texas-sized gummies and cookies, right?
Well, we don't have cookies, we have gummies. So, but yeah, I guess Texas size is appropriate. Yeah.
So, Josh, what can you tell us about the deals have you dealt with something similar in other states? Let's put it this way.
Well, I mean, every state's got its flavor. And obviously Morris is in Texas and gave I just learned a lot. So happy to have heard it. California has its own dynamic. I'm curious, Scott, whether you've seen any effect on, the tax kind of modifications that we're looking at, which, I think may be helpful. New York has been a very interesting picture to watch develop. And, we're certainly active in New York and New Jersey. And then you've got, things like Oklahoma, where it's just kind of, licenses come in a box of Cracker Jack. And that's its own dynamic. So, from where I'm sitting from a legal perspective, it's really just about knowing which flavors you're dealing with, so that you can transact accordingly.
Yeah, I think states are starting to realize that the overtaxation, overregulation, just overbearing nature of the cannabis regulatory regimes in these states are actually hurting the consumer, hurting demand, and hurting the tax revenues of the state. And look, I kind of get it. There's no state that comes into this industry. Everything starts with medical cannabis legalization. But, the governor and the legislators are breaking federal law in supporting and licensing state companies that are aiding and abetting in the production and distribution of a federally legal narcotic. This is not easy. This is not normal. So there's always fits and starts. There's no state that rolls out seamlessly. I don't know of any. But what I am comforted by, and I think, Josh, you were referring to California regarding the lowering of the cultivation taxes. The state's starting to realize that the regulatory regimes they put in are actually supporting the black market.
Yeah, absolutely. Big time.
So that's changing, and it has to change. And I think it will continue to change, even with no change in the stance of the federal government.
Mm-hmm.
The states themselves are adjusting in real time. It's just taking time.
We have an interesting audience question relating to the current inflationary situation. Are you able to pass through the increased cost of production? How is it affecting the cannabis market? Are you affected, or it's a net zero basically by the time you raise the price?
I don't know of a market where you're seeing an increase in prices in the cannabis industry right now. If anything, inflation is going one direction and pricing in the cannabis industry is going the opposite direction. So, if there are operators that are out there that are able to pass on those costs through increased prices, then and they're able to make it stick, then good for them. But I'm not sure that the competitive environment is going to enable that, frankly, because look, the consumers are price sensitive in every market that I've been in, including Texas. So, you got to have a high quality product at the right price, and it's got to be positioned well.
Yeah, I think it goes to what Scott was saying earlier about the push towards efficiency and, how important ag tech and software become, because you can cut expenses there. And I suppose from a 280E perspective, maybe if you have the balance of your expenses shifting the cost of goods sold, there's, maybe a little silver lining there in the sense of, what your taxable numbers actually end up being. But, like every other industry, I think, inflation is just, it's a difficult environment. And to the prior point, I do think it pushes towards the black market also.
Yeah, cannabis was, and I think reasonably so, lumped into these recession-proof industries with the other vice industries, tobacco and alcohol. But no industry is resistant to inflation. And it is impacting the cannabis industry. And we think at large that a number of the equity research analysts out there are still too rosy in not factoring in the impact of inflation into the companies that they cover. You're not, as Morris said, it's a little bit of the worst case scenario. You've got declining pricing on the part of the consumer because they have less money in their pocket, and you've got increased cost on the part of the operator. It's a tough, that's a sticky road to move down.
And we're getting close to the close, no pun intended, but we have one more interesting question from the audience. Anybody has a favorite capital allocation category that outperformed all else when the funding was dialed in?
Yeah, I'm not jumping in there because as a company, as a firm that represents companies and CEOs like Morris, my war stories are always on the negative side. So I'll choose to keep those to myself. Sometimes you have really positive experiences, as Morris and we have had, and it continues to be that way. But yeah, my war stories as a banker for 31 years, Lola, are saved for more private forums than this.
I would say this is a CFO question, and I'm certainly not a CFO. No. In terms of understanding the business to a point where you get your biggest bang for the buck.
Yeah, I'm not either, but I used to work in the technology space, right? I worked for the semiconductor company called Advanced Micro Devices, AMD, and the founder of AMD is a guy by the name of Jerry Sanders. And Jerry Sanders was this like renegade Silicon Valley, just icon that was there. And he was the most quote-worthy guy, that I've ever been around. And he talked about the importance of building fabs. And he said, real men have fabs, and fabs are like these huge investments for microprocessor facilities that required billions of dollars. And in some ways, building a medical cannabis vertically integrated production facility, which we're seeing happening all over the place, it's taking millions upon millions, hundreds of millions of dollars sometimes. But he also had a quote that said, building a fab or building a cannabis facility is a little bit like playing Russian roulette. The difference is that you put the gun to your head, you pull the trigger, and in 5 years, you figure out whether or not you're right? And that's kind of the way it is here, because you're deploying capital, you're making bets, they're big bets. And the bets are tied to how efficient you can be in manufacturing, how far you can drop your production costs relative to what your competition is, while the market continues to ebb and flow. And when you're competing in markets like Texas or like, other markets that are still under development, you don't really know what the market environment's going to be when that facility comes online in 18 months, 36 months, whenever it is. Right. So be careful playing Russian roulette with your capital.
I would love to close out with this joke. It was just simply a fantastic panel, great discussion. Thank you so very much. And in case somebody joined us late, I just want to reintroduce everybody. Here with us was Morris Denton of Texas Regional, Scott Greiper of Viridian Capital Advisors, and Josh Lawler of Zuber Lawler. Thank you.
Thank you, Lola.
Thank you, everybody.
Thank you, everybody.